How is the income approach used in mass property appraisal? Imagine trying to figure out what a building is worth just by looking at its structure. Sometimes that's not enough, especially for income-producing properties like office buildings or rental apartments. That's where the income approach comes into play. It helps assessors estimate a property's value based on how much money it can make. This method is especially useful when comparing many similar properties across a city or town. The process starts with estimating how much income the property could generate if it were fully leased. For example, if an office building could rent out all its spaces, what would the total rent be? From that, adjustments are made for things like vacancies or tenants who might not pay on time. This gives the effective gross income. Next, operating expenses are deducted. These include property taxes, insurance, maintenance, and management costs. After subtracting these expenses, what's left is called the net operating income. This number shows how much money the property makes before paying any loans or taxes. To turn this income into a property value, the net operating income is divided by a number called the capitalization rate. The cap rate reflects what an investor expects to earn from similar properties in the market. It considers risks, market conditions, and the type of property. For instance, if the net operating income is $50,000 and the cap rate is 5%, the property's value would be $1 million. This calculation helps determine what a reasonable price might be if someone wanted to buy the property today. In mass appraisal, this approach is used systematically across many properties. Appraisers use standard income data, consistent expense assumptions, and market-derived cap rates. This ensures that all properties are valued fairly and uniformly. It is especially helpful when there are limited sales data for comparable properties or when rental income is a key indicator of value. From a property tax perspective, the income approach helps assessors assign values that reflected how much income a property can produce. This means taxes are based on the economic utility of the property rather than just its physical features. It makes sure that properties generating more income are taxed proportionally to their earning potential. Governments often have rules that specify when and how the income approach should be used. These rules help keep the process consistent and fair across many properties. The income approach is often used alongside other methods like the cost approach or sales comparison approach to give a complete picture of a property's value. This way, assessors can be confident that their valuations are accurate and equitable for everyone.